Does it show that I'm recording, right?
Yeah, I think we are going to the session 3.
Okay. Okay, so today we're going to look at the consumer decision process in financial services, which is the session 3. Now, before we start the session, has anyone got a question or a contribution from the last time we met to share, or some observations to share? Any of you? Okay. Yeah.
Aside from the issue that I mentioned on the group chat, which is the headers being covered by the white thing.
Okay.
Yeah. Aside that, everything is on course.
Okay, excellent. I suspect that it's the differentials. I mean, I use Apple, so it looks like when I was sending it, maybe there could be a problem with there's this software, I've forgotten, that actually sometimes it kind of affect the font and the font sizes and things. So I would have.
Yeah, I know that when things are being transferred from mediums to mediums, sometimes.
Yeah, that issue.
Yeah.
So I may convert the slide to a PDF.
Okay.
So we don't have.
Okay. Okay. All right.
Okay, guys. So today's lecture, we're going to look at the consumer decision-making process. And I'm sure this is one familiar topic you might have actually come across even throughout your stay with us now. If you're not familiar with marketing, or if you haven't actually done marketing before, I'm sure by the time you joined us, as the lectures have been going on, it's most likely that you might have come across the consumer decision, because it's one of the topics that almost always, you find it in the discipline, in the subject areas. Now, before we start, who can tell us what the consumer decision-making process is? Who can just sum up for us? When we say consumer decision-making process, who can just give us a summary?
I can attempt something from just what the word said.
For sure, Michael.
Okay, I think that from the meaning of the various words in the term, I think that a consumer decision process could mean the different things, the different factors that a consumer considers before deciding to make a purchase of a product, or before deciding to subscribe to the services that are being offered.
Excellent. You're right. Fantastically right. Spot on, actually. Yeah. So as Michael said, in marketing and just as in other discipline areas, most of the time, what makes knowledge transferable is the definition and the aggregation of the activities. Sometimes you hear people say, "Oh, this is theoretical," and I really ask myself what the theory means. Really, theoretical, for us to be able to understand practice or the world, how the world is, we have to be able to put them in words so that learning or transferring it from one person to the other is easy. So part of theory is how do we package things in order that makes it possible or make it portable for us to transfer it, i.e., pass it on. And so consumer decision making is just the idea that we look at practically how does somebody come to buy, or what are the activities that someone actually go through in order that they buy something. And that is simply put what Michael has just said. So in marketing, we say that, okay, we can conceptualize the processes or the things that consumers do to the point of acquiring that particular product or service. That's exactly what we're going to do. Look at the consumer decision process. So, what is the starting point and what is the end point? And we have tried to put it in a package, or we have packaged it in a way that it is easier for you to, kind of understand it. Which means that for you, your role as managers or as people in business, you are supposed to understand this journey. And at some point you would hear consumers' journey. Some theories will say that, or some papers will say that the consumer journey. So when you hear consumer journey, it's nothing different from the consumer's decision-making process. Sometimes we fantasize with some of these words, right? So we're going to actually look at that. And as I said, your role as someone in business or someone who is a manager is to understand these processes and embed them, all right? Include them in the way you do your things so that you can perfectly reflect that journey. So it's almost as if you are enacting it, all right? You are enacting the way the consumer actually behaves, or you are mimicking the way the consumer actually behaves, so that you can actually put it in your work or the job that you do, so that it will reflect exactly on how the consumer actually behaves, for them to be able to acquire your product. So if you don't have an understanding of how do consumers actually come to the point of buying your service or the point of buying your product, you will misstep, or you would actually take certain steps that will not be reflective of that journey. And so you will miss the mark, because you will not know at what point would a consumer buy, because you're actually on a different route. Consumer is actually on a different path. And then there is no alignment, there is no congruence. And therefore you will miss the opportunity from being, the chosen one. I hope I'm clear with those words.
Yeah.
Excellent. So today, that's what we're going to look at: the consumer's behavior in acquiring what you call financial services. The steps that consumers take in acquiring financial services. So it says that in this session, we shall look at the stages in the consumer decision making and the factors and the major players that influence these stages and their roles. We shall also look at the differences in B2B or B2C. Simply means that business to consumer, decisions, or business to business decisions. As usual, if you have to ask a question, don't hesitate at all. All right, you can just put up your hand, or you can just, badge in, and that will be fine. All right. So the outline, of course, the topic, what is financial product, we would not know that. The stages we can look at, or we'll look at the rational consumer decision making, and then the irrational, consumer decision making that, we come across. Okay. So when we take a typical financial product, you would see 3 dimensions. All right. Last time we said that obviously the role that financial institutions play is a mediatory one. All right, meaning that financial institutions by themselves do not actually produce, the kind of things that they sell. All right, they don't produce themselves. I mean, no financial institution actually produces the money that they give out to people, is it? I mean, even if you are number one, you certainly are not the one who actually produces the money that you give out to people, or the gold bars. All right. So financial institutions predominantly play a mediatory role. That is, they take custody of those, products and services that they're involved in. So every financial product, you would see these 3, these frameworks. These 3 areas. One, they have what we call the input, that is what people actually put in. And then there's a time frame, that is how long that input is supposed to last in order that it gives you an output. Every financial product also has risk aspect of it. So in our determination of the output, we consider the input, the time frame, and the risks that is actually, that actually comes with, or that actually come with the product, in order that we can, fairly determine what is called the output, i.e. the result, or the profit, or whatever that we may call it. that the consumer would actually accrue or will be accrued to the consumer. So don't forget, in our determination of a financial output, there must be one, the input, which is the premium that people will put in. There must be a length of policy period, that is the timeline, that the policy or the product is supposed to last in order that they will give a particular output. And of course, there's the risks that we have to examine before you get to, the final. Obviously, over time, there had been other, factors attributable or, assigned to this framework. And some of the factors, as you can appreciate, are the, what some people would call the consumption, type. Some people would want a halal product. Some people are not so much concerned about halal product, which means that the idea of, ethics and the idea of, certain, variables, certain values have actually penetrated our consumption of financial product. So you realize that there are certain faith groups who would not bank with ordinary banks, but would want to look at a particular bank that has those values, embedded in their product and services. You realize that even when it comes to normal consumption, some people would want to find out whether the company uses minors or the company uses ethical processes in coming out with their output before they buy. And these instances, we've seen them in financial services, and that's why you have Islamic banking and all that, coming up. And you have even some people who actually put their money in, mutual funds. They want to look at the fund's investment, whether the fund actually invests in a certain type of, areas that are not that do not actually correspond to their value set before they actually invest. So these are some of the considerations that we should be aware of as the framework is concerned. So apart from these variables,
can I ask a question?
Yeah, Michael, yes.
Okay, so does that mean that if we are to ask, if somebody is to ask us to consider certain things, or if we are to be asked, let's say in an exam or a test somewhere, what the factors to consider are we to say that there are 4, i.e. these 3, and then other factors, including some of the things that you just mentioned?
Yeah.
Cultural, religious,
That's correct. Yeah.
considerations, etc.
That's correct. I mean, I do not have that academic dogma character. I believe that knowledge is very dynamic. So apart from, writing down what is actually in the slide, which is just a guide, if you provide other factors and explain them, which actually makes sense and is relevant to the field, certainly, you get it right. Are you with me?
Okay. Yeah. Understood.
I know there are some people who actually have academic dogma, position, or what somebody will call as closure. There is nothing like closure. There's nothing like academic closure. It's always about knowledge and the way you defend that particular knowledge or your rationale behind that particular knowledge. Once it makes sense and is relevant, why not? Yeah. Okay. All right. That's a good question, Michael. Okay. So we see that obviously, as we said, monthly payments, 1,500, which is an input. The time line for a mortgage, 30 years. Credit, the risk, that is the risk profile of the customer is also calculated. And then, of course, the output comes out. So once we calculate all these, that is a monthly payment, 1,500. The timelines is 30 years. What is the risk profile? The person's risk profile is 690 when you put together. Then it tells you a particular output, all right? I'm sure this is how you guys come about in your determination at work as well. Yeah, who can actually make a contribution to that? Is there any different? Is it any different from how you determine loans or interest rates or all those things.
I think it's in order because we
go
deal
on.
with the number of tenor.
Mm-hmm.
It's the same thing.
Okay. All right.
Okay.
Yeah, go ahead.
So, for instance, in recent times, because of the volatility of rates, and the fact that customers have been complaining about high rates and all those things, so the regulator, Bank of Ghana, brought up the reference rate, the Ghana reference rate.
Yeah.
So every bank now knows that every month we have a flat reference rate that is given by BOG.
Yeah.
And then you as a bank will assess the risk profile of the individual or the entity you are giving the amount to. You look at the term, the number of years you are going to.
That's right.
And you use that, looking at the amount you are dishing out, you now be able to dictate how much they have to pay monthly plus interest. So
that's right.
Today it falls into what we are discussing now. And so in terms of the risk assessment, for instance, they are graded from, let's say, A to F.
Yeah.
So depending on the credit history of a customer, if they have worked with you for a couple of years without defaulting, then they have a good credit rating, as we see practiced mostly outside. So you have a good credit rating, you have a good credit history, the number of years that you have taken, you didn't default, you have paid up and everything, to rank you. And then we'll be able to determine the final percentage to hit you with. And then you are going to pay on a monthly basis. So I think it falls in line with what we are describing now.
Excellent. Yeah. So as we mentioned, because the financial institution is an intermediary, or is an only mediates between the customer. Remember, it's about the customer who is actually taking out money and the customer who is actually bringing in money. So the depositor and the one who is taking out money, which is the one who is looking for loans. So always the financial institution is actually mediating between these two people, the one who has the money and is bringing it, and the one who is actually taking out the money. And then the regulator is supposed to ensure that this, relationship is cordially, managed. And that's why the regulator will come out with a baseline of, performance. So when you look at it, no institution actually goes below the regulator's, floor, or actually goes above the regulator's ceiling. So you realize that the competition actually hovers between the regulator's floor and the regulator's ceiling. All right. So there is a price floor for loans and there's a ceiling for loan. And you will realize that everybody actually moves between these two, points. Now, if you take the credit, for example, so there's a baseline for risks and risk levels that banks can actually take. All right. Now, just like as Gilbert explained, so you are looking at the history, the credit history. You're looking at the load, that is the credit load for this consumer, i.e., how many loans have they acquired within a space of time. So they will ask you, do you have any other commitment somewhere? You're supposed to disclose if you have a loan with other institutions, and that could actually affect your capacity or your ability to pay. Obviously, in the risk assessment, we are also looking at your geographical area. Where do you live? All right. Where do you work? We're looking at that. We're looking at your demographic. All right. Are you an older person, or you're a young person, or you are in between? All these actually determine your risk profile, isn't it? So yes, just as we have explained, the financial institutions are actually looking at these factors, and then of course its impact on the final output. Then the output is determined, right? Okay, great. So if we look at the financial products, obviously we have, auto insurance, home mortgage, mutual fund, certificate of deposit, we have money transfer. All of them have their inputs, all right? If you take auto insurance, for example, the input is yearly premiums, isn't it? And in some cases, because of competition, they will stagger it to make it a monthly payment or a quarterly payment. If you take home mortgage, for example, the input is monthly payments. If you take a mutual fund, it's about an investment amount, isn't it? So how much are you putting in at a point, at a period? Certificate of deposit is about how much deposit are you putting in. Money transfer is about how much you are transferring, and of course the transaction cost. Now, if you look at the risks that is used to determine the output for these services, auto loans or auto insurance actually look at your driving history, all right? Record of the driving record of the applicant. They will look at the age of the applicant. They would also look at the the geographic, of the applicant. That is where the applicant actually lives. Why? Because where you park your car can have an effect on the risk levels, all right? And then, of course, they sometimes look at the gender, which we have said, the demographic of the applicant. If you take home mortgage, for example, your credit score is very important. And your credit score, as we understood from, Gilbert, is looking at your history, your load, obviously your demography. That is whether you are a young person, you're an adult, or you are a very OAP, that is overaged person. They all actually come into the determination. Mutual fund is about your fund strategy. And as I said, some people, it's also about their what do you call, their age as well, their demography. And if you look at certificate of deposit, it's about the insurance from the what do you call, the regulator, here you talk about the central bank, isn't it? Because they actually regulate, certificate of deposit, etc. That is buying government bonds or all those, kind of policies. Then, of course, money transfer, you're looking at the likelihood of the funds not being received, all right? So the risk aspect, you're looking at network issues, if the network goes off, obviously the person is not receiving it. Or you're looking at fraud, all right? Those who do Momo fraud, all these are some of the risks that we're actually using to determine it, all right? Now, yeah, Michael.
Can I ask something quickly?
Yeah.
With the risk for certificates of deposit,
yeah.
I wasn't very clear on the explanation for how that is a risk.
Okay, all right. So risk for certificates for deposit, it's about the performance of the, okay, I think I didn't actually, make it. It's about the performance of the economy, all right? The performance of the government policies, etc., would actually have an impact on things like bonds, all right? And sometimes when people actually secure government can actually postpone the payment of certificate of deposit, for example. Although there is a rule that I think those of you who actually said, is it quarterly? Those of you who are in the banks, when you buy what we call the bills, treasury bills, etc.
Okay. The T-bill, we have the 6 months and the 4 months.
Yeah.
But with the bonds, the minimum year is 1
2
years. Yeah, mm-hmm. But normally the certificate of deposit is the banks.
The banks issue them.
Yeah, they normally peg it with the T-bill rate. Look at it and see if for them to retain their customers, if they can give how will I say, a competitive rate as compared to the T-bill. So okay. You have some being 17, then we compare it with the T-bill. So some of the customers will prefer doing the certificate of deposit with the bank than paying into the bonds.
Yeah, Bridget, what's the difference between the certificate of deposit that the banks are issuing and then the treasury bills that are actually issued by the government, in order that will sway a customer to actually take the certificate of deposit as opposed to the T-bill bond?
With the T-bill, normally it's discounted, and we use the Bank of Ghana rate. So they give us a rate, maybe a rate at the last auction was 13%. So based on that, when it comes to the bank, we give you this rate. This one is discounted. It means they can even pay your interest upfront or at the end of the maturity. But with the certificates of deposit, we have something we call NCB, Cocoa Bill, and Co that the banks do. So those ones, when you come, it's not discounted. We pay it at the end of the period. Let's say if you decide to choose the 91 days, we pay your interest at the end of the period, not upfront. That one is tight, and we make the negotiation. So at times we make it a little higher, let's say 2% higher than the T-bill. Some will prefer buying it, others will prefer T-bill.
Okay. Now let's seek another clarification. Does it mean that the interest that you get or the returns that you get on the certificate of deposit is fixed, and that of the T-bill is actually variable?
Yes, for the period, the T-bill, it depends upon the rate at the auction. Maybe if at the end of the last week auction, it was 13.9, it means it's not guaranteeing that during the next auction, maybe in 2 weeks' time that you are buying, you get the same rate. It changes.
Okay, so it changes as a result of the performance of the economy, right?
Yes, please.
Yeah, but then you fix certificate of deposit.
Yeah, those ones are for a period and it's fixed. It's dependent on the amount. Before you can get a better rate than the T-bill, you should be investing, let's say, from 500,000 upwards. Then it will force us to give you a better rate than the T-bill. But if it's normal, then you go for the T-bill.
Okay, so Michael, you get some understanding there, right?
Yes.
All right. So yeah.
Just on the issue of the variability.
Yeah.
When you book, I don't know if this is what we are trying to imply. Let's say I come and I book a T-bill for 91 days.
Yeah.
The rate that I have for the 91 days runs to the end of the tenure. If next week the rate of the T-bills on the market varies, either goes up or is lower.
That's correct.
That was fixed for me is what pertains to the 91 days ends.
Yeah.
So I was trying to understand what you meant by variability.
Yeah, that is, it changes from period to period.
So for me, if I have booked it, then it is fixed for me for the 91 days that I have fixed it.
Yeah.
If it's 6 months, it will only vary if it matures and I want another one. Then the current existing one is what I will go for.
That's correct. So because investments usually are long-term, especially when people put, monies for some of these things, they're looking at it rolling over a period of time. So you're most likely to see the variability as and when the period ends and another one is started, just as Bridget actually explained. So that is highly dependent on the consumer, and that's what we're talking about, consumers' behavior or the decision-making process. So if the consumer is one who actually is looking at a very long-term investment portfolio or a very long-term investment outlook, then certainly going for the the T-bills, they're likely to experience certain variability in terms of the return. Now, for customers who are perhaps maybe less risk, who are more of a risk averse, all right, are most likely to accept the T-bills because it's government, all right, it's issued by government.
Yeah.
And regardless of the situation, they will be paid anyway, all right? Yeah. Only that the returns could be, variable. For those who are not really, risk, well, who are actually risk, I don't know, but they have very positive attitude towards risk. They may want to go for a high yielding, product.
Yeah.
Without necessarily considering the risk issue. Once they can actually get a higher payout, they are fantastically okay with that. So yes, that's the frame or the concept that we're trying to explain.
But Doc, sometimes some of the customers, when they come, some maybe I want to lock my money for 1 year.
Yeah.
So for that one, they are prepared to lock the money for 1 year. Then they go for the bond. And normally the bonds are always higher than the short term and the T-bill.
Yeah.
But it's just that the bonds, they pay your interest half, let's say every 6 months. Okay, so like if you buy, let's say 1 year bond, then your first interest payment, they will pay you in the 6 months, then the remaining one at the end of the maturity.
Yeah.
So like it's dependent on, some want to use their money for something. For short term, then they go in for the 91 days and the 182 days.
Exactly. Yeah. Okay.
And
great.
so I wanted to comment on the auto insurance.
Yeah.
With that one now, the third party and the comprehensive thing that we do, sometimes they don't even put emphasis on the demographic of the customer. Like with the third party, it's a fixed amount. You pay 327. It doesn't matter even how much you use your car or anything. So long as you pay the 327, you are covered for the year.
Yeah.
But it's a comprehensive that we look at the risk.
At that risk. Okay. Yeah. So these are some of the what do you call the factors in the area. I mean, I have always argued that why would you want to actually have a policy that is almost like one cap fits all, whether it's a comprehensive or whether it's a third party, because certainly the behavior of men are completely different from the behavior of women. And it's on record that men drive, carelessly than women when you compare the two genders, all right? So the idea is that why are you charging men and women in terms of even comprehensive, why are you charging men and women the same rate or the same premium because they use the same car? And then of course, they have other, the variables of the car are the same. But of course, the attitude of the drivers are different, where they live completely different. And it's on record that where someone lives actually adds to their risk profile, isn't it? So you realize that our financial sector is not actually up to speed with current trends of determining what risk, factors, and making sure that they can actually be fair in the attribution of what you call premiums or determination of premiums. I hope you guys understand what we're discussing. Yeah, are you with me?
Yes, sir.
Okay.
Yes.
Right. If you have any questions, you can ask, all right? Okay, so let's look at the what we call the rational consumer decision-making process. And this, we're talking about the consumer making a conscious or deliberate effort in, coming to buy or in their journey towards purchasing, a service or a product. And then we'll compare it to some of the irrational decisions that, some consumers also actually take. So we're saying that rationally, a consumer is supposed to identify that they have a need, all right? They're supposed to recognize that they have a need, and that recognition will lead them to take an action, all right? So the rational consumer decision says that need recognition may come from two points, all right, or two sources. The first source may come from within. That is, you recognize that, oh, you're hungry, yeah? And so you would take the effort to look for food, isn't it? You recognize that you are broke and you take the effort to look for loan or to look for money. Or it could come from external stimuli or external stimuli, i.e., there's an advert that is telling you that, my friend, you need to have television because that's what everybody is going for, all right? Or my friend, you need to have an iPhone, or you need to have a smartphone, because everybody is going for that. And majority of these kind of need determination, they would compare your state with the state of people like you, i.e. your relatives, your friends, and say that everybody is going for this particular, item. Why are you alone using something different? So once these sources actually trigger, the gap in your state of affairs, the rational consumer decision-making process suggests that immediately you will take the steps in, fulfilling or in solving that gap that had been triggered in you. All right. Now, from the need recognition goes to the next stage, which we call information search. The information search says that immediately you recognize that there's a gap that you need to fill, and whether that gap was triggered by whether that gap was triggered by an internal stimuli or an external stimuli, you will go ahead to look for information regarding that particular, or regarding fulfilling that gap. And that information search stage could also be two ways, internal and external, all right? The internal means that you will first of all scan your previous experiences that you have had. So if it's about you being hungry, you scan yourself and ask yourself, oh, what food did you have this morning or this afternoon? And whether that food, you appreciated it or not. So if you realize, oh, this morning I had, tea, or you had beverage, and you feel that, oh, it was okay, you want to take another beverage, then you go ahead. Or you think that, oh, the beverage that you had was too light, obviously it's afternoon, so you want to have a little bit of fufu, right? You go on to have that. That is your information search from within. So in most cases, we would actually start the information search from within. That is, our previous experiences will determine whether we would actually make another choice that we made earlier, or same choice that we made earlier, or we'll go for something else. And whenever the decision is made to actually fall back on the previous choice that we made, it means that the previous choice perhaps was satisfactory, i.e. we were happy with that choice. And that's why we are falling back on that choice to actually fill the current void that we experience. Now, if that choice wasn't good enough, that is, the previous choice wasn't good enough, we may fall on other choices, but then we may not have enough information to actually confirm or to actually evaluate that particular choice that we are trying to make. So we will seek further information. And usually when we're seeking information, we end up going outside, all right? Maybe asking our friends and relatives, or consulting authority, so-called authority, or people with certain expertise, that can actually tell us, that, yeah, go for this choice and go for that choice. We may actually consult sometimes an advertising information. Maybe you saw some information in a a magazine, and your mind will go, oh yeah, I think I saw some magazine, and this is about a new dress that you want to purchase for a wedding. And you're actually thinking, initially you went to your wardrobe because you have so many clothes in your wardrobe. And when you checked it, you realize that none of them is fitting for that particular wedding. Then when your mind goes to the external information set, you remember that no, you actually saw a dress in a magazine. Then you go and consult that magazine to check it out whether really, it's something that you can go for, by looking at the style, by looking at maybe where the seamstress is, whether you can reach them, maybe there's a price that is actually stated on it. All these information could be gathered, and we're saying that the information gathering stage can be two ways as well. That is internal and external. All right. I hope you're following. Hi, guys.
Yes, we're following.
Okay.
Thank you.
Yes.
Sometimes I want to make sure that I haven't lost connectivity with you. Okay. Yeah. Okay. So from information search stage, the rational decision-making theory says that we will move to the next stage, which is pre-purchase evaluation. Meaning that once we've gathered the needed information, all right, and sometimes the information may return 2 or 3 alternatives, that is 3 products or 4 products or even 5 products, all right, all of them seeming, appropriate or fitting to the occasion or to the need that we have. Now, in that case, you are supposed to, obviously, you're choosing one out of the lot, all right? So the rational consumer decision-making process suggests that we would come to evaluate, all right, these choices, these options that we have to evaluate them and then choose one. So in most cases, there are certain frames that we would use for the choice, for the evaluation. Again, we'll fall back on an internal and external, sources. And one of them is about whether this new choice that we're about to make is actually produced by a consumption that we have actually done before. That is it by a manufacturer who actually, manufactured the previous product that we had before, or it's an entirely new person. Now, if it's a manufacturer who actually produced a previous product that we had before, then whether the experience was good or bad would inform the decision making, all right, for choosing. So if it was let's say you came to Legon for your undergraduate and you had a very good experience, the decision making process here says that in terms of choosing for your master's, you are likely to actually select a master's from Legon as well, perhaps because your undergraduate experience was fantastic, all right? So you may use an internal information that you have prior in evaluating the current, choices that you're making. Or again, the purchase evaluation may sit on certain factors such as availability, affordability. So is the price tag something that you can afford? If the answer is yes, you probably will go for that, one that you can afford. If the answer is yes, but then price is not only the concern for you, then again, you're looking at availability. Is the product available, all right, for your evaluation? So again, when it comes to the pre-purchase evaluation, you probably can fall on what we call the 4 Ps or the marketing mix, which is the product itself, that is its content and its, portability, etc. Or you're looking at the price tag, or you're looking at its distribution, that is accessibility, whether you have an access to that, or it's a faraway product, or it's very near to you, etc. You're also looking at its availability, and then you're also looking at its promotion. Is it a well-known product? Do people actually know it? Have you been seeing it around? Does the organization or the company seems to be a very responsive one that really can give information, as and when you need it? So all these factors actually go into your pre-purchase evaluation. Of course, it's not exhaustive. You have other factors that you may consider. And as I said, some people are even using ethical issues, values, certain value sets in their pre-purchase evaluation. They would ask certain questions such as whether the product is actually produced with, adults, not using underage people to produce it, or are they not actually, they are not actually underpaying their workers? Are they actually committing to the rules, etc.? So people can use so many other, frames or other factors in evaluating the product before they make their choice. All right. Are we clear here?
Yes, just that it seems as if that there's a blurred line between information search and pre-purchase evaluation. It seems like both are quite similar.
Yes. So you're right. They're similar because the information that you gain, and don't forget, just because they're separated in order that we'll be able to transfer. All right. But most of these steps actually occur in the twinkle of an eye. Are you with me? In fact, you may not even see the difference between need recognition and information search in its practical sense, because they can happen at the same time. Are you with me? So as you're actually searching for the information, you probably will be evaluating it even along the line. So the difference may not even occur to you. So sometimes by the time you finish gathering information about what you want to eat, you had even finished evaluating it. And I'll give you a typical example. All right. If you're standing by roadside, you are stopping a car, all right, a taxi, you want to get a taxi. Now that Uber is here, so we don't see much of it before it comes, all right? Sometimes you request an Uber and the car comes and you think, but is this car to an Uber? Yeah. Because it didn't have, the ability to actually judge it. But those days when we used to stop, and I'm sure we still do it, we used to stop taxis, Sometimes you'll be standing there and the taxi is passing. You are looking for a taxi, but the taxi is passing. You won't stop it. Why? Because if you look at the nature of the taxi itself, the way rickety is looking. All right, you don't even want to put your hands up. All right. Sometimes you may even put your hand up before you realize that, this taxi is not nice, and then you put your hand down. Then the driver asks you, "Are you going? Walk. You say, Debbie. All right. So because the information search and the evaluation is actually happening at the same time.
Yes.
So that's how it is. So sometimes by the time you finish the information search, i.e. knowing where this product is sold, knowing, whether the product can actually fulfill your needs, etc. By the time you finish, you had already finished the evaluation and made your choice. Are you with me, Michael?
Yeah.
Yes, I'm with you. Understood.
Yeah, so sometimes it can happen at the same time. All right. So the rational decision is saying that after that evaluation has happened, then we settle on one. That's where purchase happens. So you are now clear that this option is what you're going for. So you go in and then you make a purchase. Now, as you're making a purchase, there are a lot of things that actually, transpire as well. Obviously, the purchase process includes, your what do you call, filling certain forms, all right, making commitments, i.e., giving out money, and then the experiences from the seller, the conversation, all right, between you and the person who is actually selling it. And then, of course, you putting the product to use, all right, that is, getting the product. If it was a loan that you acquired, you realize that even the consumption actually starts immediately the money has been acquired, because the banks even start deducting you before you even apply the money to your business, isn't it? So from the bank's perspective, they said that, this loan may start attracting interest next month. But you yourself, you haven't actually applied the money to the business that you said in about 2-3 months time, but they have started deduction, all right? So you realize that the purchase itself and then the consumption are actually happening almost at the same time, just like we were talking about the information search and then pre-purchase evaluation, all right? So purchase period and the consumption are almost happening, around the same period of time. And then, of course, you come to the post-purchase evaluation. That is where you are also, just like the pre-purchase evaluation, you're looking at whether the product was actually fitting to your needs, as you consume it, all right? You are thinking, was it the right purchase that you had? Or you could have had a very good bargain, or you could have had a very good deal, than this one. So those are the kind of decisions that people actually take or make, before they come to buy. And then when the post-purchase evaluation doesn't actually go well, we experience what we call the the dissonance. All right. Those of you who have done a psychology before, you experience what we call post-purchase dissonance, i.e., regret. All right. You regret the purchase that you did, or you are happy with the purchase that you actually made, where satisfaction actually sets in. So in total, we're saying that before a consumer or a customer actually buys a financial product, the rational decision-making process says that they go through these steps, all right? And we're supposed to, as managers or as business people, understand these steps so that we can factor that in our management process or our approach to attract the consumer, all right? So if we realize that need recognition happens in both ways, all right? That is, it may actually be that somebody has a need for loan, or they are broke, and that's why they need money. Certainly, that would reflect in our adverts, isn't it? So when we are placing an advert, we're actually enacting that particular situation. So in an advert, you see that Kojo is walking around, shaking his head and say, hey, so what would I do? You know, how am I going to solve this problem? Dolores, right? So that's what we use in our daily process. So immediately the consumer is sitting in their hall and watching the TV, and they see Kojo shaking his head and say, what will I do? It prompts them, it makes them look at their own situation and say, I think I'm in a situation like Kojo, all right? Because as I speak, I'm also broke, etc. In this case, the company or the financial institution is preempting. That is an external stimuli. It's getting the consumer sitting in his home to think that he also needs loan. So he needs to go to the company. So we are actually getting these things to embed them into our practice, all right? And then, of course, Kojo then calls a friend who is actually enjoying. He said, Charlie, I'm suffering. I really need money. But you, where did you get this money that you enjoy? Then the friend will laugh, ha, 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 ha. You know, it is SSG, or it is, what do you call, Gilbert's company. What's the name? Gilbert, your firm, your bank. NIB. It's from NIB that I got this money from. And I say, really? Oh, so if I go there, will I get immediately? They say, yeah, you go there, immediately they will sort you out, you know? So we are factoring these processes, you know, into our processes, all right? Because we know that consumers actually go through these stages, all right? So they plug in the information in this way, or you put that on your website, because you know that people would actually come to your website if they themselves find that they need a loan. They can go onto your website and then look at the information. You know, how much can they take from you? So you then plug the range that people can actually secure from you as a loan. And then what kind of people? So you can say, if you're a salaried worker, you can get up to so and so amount of money. If you're not a salaried worker and you are what you call business owner, you can get so and so amount of money. That's the information search stage, all right? You're putting information there to make it easier for people who recognizes that they need help or they have a certain need to be able to choose you. And when it comes to pre-purchase evaluation, you probably want to compare your, you know, offering with the market. So you see some of the website, they will say, we offer this, and this is what you get from our competitors. In order that they can actually put you under one umbrella without you moving to go and check the competitor, because you are thinking that whatever they have put there is right. So you see theirs and they say, we charge this, competitors charge that. And then you go, wow, then these people are cheap, you know? So you may not even be tempted, may not be tempted to go and check what NIB is providing, because Bridget and ABSA people have managed to put all the information under one umbrella, supposedly showing that they are much cheaper than their competitors. Are you with me? So the information or the pre-purchase evaluation is actually happening at the same time as you're watching their website, and you're not even tempted to go and check or confirm with the competitors, what they have. Are you following it?
Yeah.
Yes.
Okay. All right. So obviously from then on, then you go to the purchase. Now, companies are now using so many, platforms to make sure that consumers can immediately consume or purchase their product, quickly and easily by telling you that, okay, if you are really into getting this loan, there's no need for you to come to our office. Why don't you fill the form online? They make the form available on their Facebook page. They make the form available on mobile phone and say, you can just send this short code and we can send you the form to fill. So they make available so many platforms of so many sources through which people can make the purchase in order that they can actually speed up the purchase process, or they can actually acquire the customers much more quicker than it should be, or it could be. So knowing that a lot of people actually use mobile phones, all right, you want to make sure that part of your platforms to purchase, or for customers to purchase, is mobile. Knowing that people perhaps would want to use a QR code to purchase without necessarily going through their bank account, you make QR code available so that they scan and off they go. All right. Again, in terms of consumption, people, in order that people do not experience post-purchase evaluation, some businesses make sure that they actually, or some financial houses make sure that they actually take the consumer through the consumption process. For example, you've gone for loan, and you know that if you don't apply the loan to the right thing that you want to use the loan for, in order that you get the right return, you'll be unhappy that you went for loan and it wasn't used for its purpose. You may end up blaming the bank, because you hear a lot of people say, oh, don't go for loan. When you go for loan, you'll be in debt and you will never get your business to the level that you want. Why? Because majority of people are not competent enough, or not majority, but people are not competent enough to actually make good use of the loan that they went for. And I'm saying that because it's on record, and I'm sure those of you who work in banks know that people will go for loan, and there they start tipping even the one who is giving them the money, right? So the person who does the loan assessment and then all those things, and then there he's thinking, okay, let me give this woman who helped me to secure this loan 10,000 or 5,000 or 2,000. Of course, that is going to have an impact on your what do you call your objective, isn't it? Then of course some people will proceed to go and buy car, and we hear these stories most of the time, right? That somebody goes for loan to inject into their business, and then quickly they buy car. But was the car part of the objective? All right, is no. So by the end of the time, by the time that they exhaust the money, they have actually made irrelevant purchases, have applied the money to irrelevant points that were not part of the decision in the first place. What happens? Post-purchase evaluation comes, and then they're actually blaming the fact that they went for loan and didn't find anything, or didn't actually realize anything good, all right? Because of that, some financial institutions would actually be part of the process. So they can actually dedicate a staff to this customer to make sure that they are going through what the money is supposed to be used for. In fact, it's a case that some arrangement could be that they would even release the money to you bit by bit, in order that they can make sure that the commitment or the objective that the money was actually assigned to is being done. Any comment or contribution from you guys on this point? Or have you realized there's a case study that some of the things that I'm talking about came in?
It's true, say some even take loan to get money.
But then they took the loan for their business. All right. Any other ideas? Any other points?
And also say mortgages, when you take the mortgage, they don't give the money to you.
Yeah.
They give it to your estate developer. So normally they don't pay everything.
Yeah.
The mortgage only pays 70% of it. But some of the customers, they think, I've seen a house, I want you people to go and buy.
Yeah.
They think the bank will go for the whole amount, but it's not the case.
Exactly. And one of the reasons why mortgage, I mean, obviously they deal with the contractors, is that this is a long-term, spanning 25 years, 30 years, and huge money is involved, all right? So clearly, if they had to actually be a process where the money is actually given to the customer directly, surely you could actually sense the implication. All right, a lot of people would have been dead by now without necessarily getting, the houses that they're looking for. So there is a reasons why some of these policies are there to guide, appropriate use of the resources or the consumption that they're actually, going for. All right, good. So that's the rational decision making in the process. And our understanding of it is that once we're able to appreciate the process, we'll be able to, incorporate that into our work stream so that we'll be able to, work with the consumer side by side in fulfilling their objectives. Okay, so let's look at some of the consumer decision-making processes. I mean, the rational decision process that we have explained, and link it to certain, product types within the financial, services area. Now, if you look at need recognition, for a check, and these are two products that we're looking at, a check and a mutual fund, right? So for a check, the the need recognition process will be necessity. So you have, the need for, a check account, and check account is just your daily use of, your money, isn't it? Which we call the current account.
Current account, yeah.
Yeah. So you know that daily you would need an amount of money, and that, would prompt you to put the money there and then put it in a current account so that you have access to that. Now, with need recognition for mutual fund, it will be asset growth, which means that you've had some money, you're okay, but then you want to make sure that you can grow your asset, your properties, all right? You can grow it so that at some point in time, you will not be found wanted. So money that you get, the excesses that you get, you want to put it in a particular, growth, asset growth. So you do mutual fund, which is more of an investment, as opposed to the check account or the current account that is about your daily needs, all right? But mutual fund is more an investment, and that is the need recognition will be that you need to grow your assets so that in future, for example, even if you come out, you come on retirement, or you have a baby, or you have extra responsibility, you'll be able to easily take care of that responsibility. And so you'll be there, and then the need will strike you that, I think I need to grow this asset that I have in order that I can have, more money or more wealth, all right? Now, for information search, the location for the bank or for the financial services is crucial when it comes to, check account, for example, because daily you want to take money, all right? So you don't want to actually put it in an organization or a company that is far away from you, or that access is limited. And that's why when you go for, money that you are going to be used every time, they will say that, okay, go for what do you call current account as opposed to savings account, because, savings, you can't get access to it every day. So the location or access, in fact, we can replace location with the word access, makes it easier, for you to actually go for a check account. Now, for mutual fund, the information search need will be name recognition. Yeah. Now, because in mutual fund, you want to look at which company actually is good or is known for returning good value in terms of your asset or in terms of your investment, isn't it? In this country, which firm will come to mind if you want to grow your assets? Yeah. Any answers from anyone?
Hello.
Yeah, Gilbert.
Maybe number of years in equation, the first might be data bank.
Exactly. So data bank has assumed that name recognition when it comes to, considering mutual funds. I think the M fund, for example, is it M fund, right? It is one of the most popular, what do you call, fund in an account people actually make references to when they want. Which one?
EPAC.
EPAC. Yeah, EPAC. When they want to actually grow their assets, right? Now I remember those days. It used to be what's the name that company? That was NTAC. All right. I remember those days. Growing up, NTAC was so popular until Databank came in, and then they started what they do, and then I think that NTAC actually went down a little bit in terms of popularity for that name recognition for that. Then when it comes to pre-purchase evaluation, most of the time for current account is word of mouth, isn't it? People will say, oh, maybe go to this bank or go to that bank, or your own experiences with banks would actually tell you where to go, right? Now, when it comes to mutual fund, you're looking at fund performance. Most of the time, you want to make reference to some annual, AGM or some what do you call periodics from the industry or from the company itself to look at their fund performance over the years and then making a decision, or listening to, let's say, even business news, on the radio stations or the TV stations to actually understand which of the fund is performing very well in order to make a decision to actually put your money. And then when it comes to the purchase, you open an account, all right, for a current account. Obviously, you purchase shares when it comes to mutual funds. And then consumption, in the consumption process for current account, you may be given a check, ATM card. These days, mobile banking, services or online banking services. For mutual fund is about you observing the growth of your fund. So you're getting news, or you're getting updates about your fund and its growth. From time to time, they will send you those information. And then post-purchase evaluation, accuracy of your statement, satisfaction with your statement, queue at the banking hall, or ATMs working or not working. All those things will actually come in, to aid or to help in your post-purchase evaluation. For mutual fund, whether the fund had grown to the expected rate that you were expecting sometimes. And to be honest with you, I put my money at NTHC, I think when I was leaving Ghana, right? That was in 2000, between 1999 and 2000. When I was leaving Ghana, I put my money at NTAC, roamed a bit, came back in 2005, I think 2005 or 2008. I went for my money and it hadn't gone anywhere. I was so surprised. I went there and said, but I put this amount of money. They say, yeah, the economy is not doing well. So obviously my funds were not going anywhere. And people said, oh, EPAC, as you guys were saying. So I de-invested, my money, and then I went to data bank to put my money there. I roamed a bit, came back, I think in 2013, thereabout. And the money had actually been in reverse. Like it's actually gone back, I was like, okay, so let's say I put in 5,000. Now I come back and the money is somewhere like 2,000, 3,000. Again, citing economic issues. And then I just, took my money there. I wanted to close the account. They said I couldn't close it. So I just left some few coins in there. You know, so these are some of the things that you go through in post-purchase evaluation. And since then, I've not been interested in actually having mutual funds. I mean, putting my money in any of these investment packages. You know, so definitely I've had post-purchase evaluation done, and I've become very dissatisfied, i.e., what do you call post-purchase dissonance setting in for me. All right. Any questions or contribution? Yeah. Any questions or contribution? Okay. So we'll move on, right? Now, apart from the, what do you call, the rational theory that we're actually going through, that consumers actually go through these predetermined stages, there is also the theory that we may not necessarily go through rationally or a determined phases in terms of consumption. There are some consumptions that we probably may do, or we may actually go through irrationally, or there are some decisions that we may take irrationally. And there's also the decision that even when we go through that rational process, at some of the stages, we may not even be that detailed, all right, in our decisions. For example, how many of us actually buy a car and make sure that they test drive it before they buy? A lot of us will use what we call heuristics, like shortcuts in making determination and thinking, oh, this guy is good. Why would we say this guy is good? Because you're looking at the body and it's so strong, and some people would even hit the tire with their legs, all right? And then maybe the sound makes it tells them that, oh, the car is strong. Some people would open the bonnet, check the engine. Little do they know that the engine has been washed, but they look at the engine and it looks so fresh, and they think, oh, this guy is in good shape or is in good condition. So there's an understanding that perhaps we may not be that right in thinking that consumers actually go through rationally each of these stages thoroughly in making the decision. And so there is a proposal about irrational decision making, which we are also supposed to factor that in, you know, in our daily operations, you know, to make sure that we can actually reflect on the consumer's, you know, way of purchase. And so if you take some of these, you know, characteristics or some of these practices, for example, Christmas clubs pay no interest, you know, to depositors. Customers deposit money each week, but could only withdraw the money on December 1st. All right. Now, simply saying that, why would customers take that action? All right. For example, if you take the money boxes, you know, those money boxes that we used to do, you know, when we're kids, or even elders, some people actually do that. Now, why would people actually put their money in Christmas clubs, all right, or in certain clubs that do not pay any interest, but can only withdraw the money on December 1st, and still they will do that, although they're not getting any interest and they're not getting access to their money until December 1st? Why would people do that? Who can answer that question?
Perhaps because they don't trust themselves to not touch the money.
Excellent.
Excellent. During that period.
That's it. That's all the reason. Because the person has no control, self-control, to make sure that they don't chop the money before December 1st. And you know, December is so crucial for a lot of people because you want to buy something for your auntie, you want to buy something for your mom or dad, you want to buy something. And when it gets to December and you don't have money, it's a very miserable situation, you know. So people want to actually take certain decisions that could guarantee them some amount of money that they can spend during December. And so instead of actually putting it in a bank or, you know, somewhere, they would want to put it in certain restrained or constrained sources. Because when they put it in a bank, they may still get access to it and spend it. So there are emerging clubs where the rule is that we will protect your money for you until December 1st. But the condition is you will never get access to your money and will not pay you any interest. And that is actually gaining popularity. People are putting their monies there because of these things. I mean, the issue that Michael raised, because people lack, what do you call self-discipline, not to touch the money. So it is irrational to think that they won't pay you interest. They will not give you your money even when you need it before December 1st. Yet it's gaining popularity. But it's just because people can't trust themselves that they will be competent enough not to touch the money, all right? So another situation that we find ourselves is that increasingly people, the use of debit cards, of course, this is much more Europe, all right? The use of debit card has surpassed the use of credit cards, all right? That is, people are increasingly now falling on their debit card than their credit card in Europe and Americas and all those places. Why? Because those days, I mean, credit card was fashionable. I mean, free money, so to speak. That's what they call. Get this money, spend it, pay small every month. But over time, people have realized that, no, this is not good. So they are now using what they own themselves, which is debit cards. And in our country, for example, or in Africa, majority of people spend the money that they have, all right? So why do you think that in Europe and America, where credit card was so fashionable, free money, spend it and pay small in a month, why is it that a lot of people are now switching back to debit cards other than credit cards?
I think that with credit cards, it's easier to accrue a lot of debt because you lose focus of how much you have and how much you're actually borrowing.
Excellent. So people are realizing that they are in debt even at the time that they are passing away. I mean, when they are dying and they have nothing to leave, their children. People realize that they are accruing too much debt, that they can't even do anything. It put them off the credit rating. So when it comes to they executing some important decisions, they can't do it because they are heavily indebted, all right? And because of that, people are now shunning credit cards in place of debit cards so that they could be in absolute control of their lives, and therefore they could actually leave things behind. And again, another issue is consumers' use of overdraft line of credit on check accounts, despite that they have monies in their savings account. All right. Again, the practice is that although consumers are actually giving, although consumers may have savings, all right, they resort to the overdraft account, and then they leave their savings. Why? Because a lot of people realize that, the charges, the interest rate charges on overdraft is less than perhaps going for loans, all right? And then obviously is less than, they not have money at all. So they keep their monies in their savings account, for purposes of meeting certain eventualities or meeting certain important commitments, because if they have to finish their their savings and they get into those problems and they have to actually take a loan, etc., those interests are expensive, than they using their overdraft. So all these are some of the, the irrational behaviors that people are actually, taking. Now let's come back home and cite some examples. And one typical example you can look at is the current situation that we started having with the men's gold, all right, DKM, and what else? Some other ones. What will be the basis to explain these happenings, especially men's gold? Brings X amount of money, takes some gold nuggets, at some point will pay you X amount of money. What are some of the explanations that we can ascribe to these things?
Ghanaians, they were greedy. Because
the greediness, Do we agree? Greediness. Yeah.
Greediness.
Yeah. Okay,
Because,
go on.
do you know, if a customer was sharing his experience, he spent 100,000 there, and with a period of 2 years, he got more than that. So for him, he was able to recover his 100,000 back. So for somebody who just took a loan 40,000 and invested there, his money was locked. The person didn't get it because people were getting proceeds from it. They were in a edge to go to a men's gold. People withdrew some of their monies and deposited because of outrageous rates. They think it was the best. The banks, we are jealous of men's gold. They took their monies there and it got stuck.
Okay, so to bridge it, one of the reasons is greediness, right? Okay.
Yeah, greedy.
Okay. Greedy. What else? What are some of the things that we can assign to this behavior? Short term, bring your money. Short term, we'll turn it into magic, big money for you. Although this is not what fundamentally the interest rate, etc., we're actually looking at.
I think another factor is the fact that there were actually success stories in the first, at least, for a very long time, there were a lot of customer testimonies about how money had been doubling and tripling in some
success
instances.
Yeah,
exactly. So that influenced people to think that they could also benefit like how people that they know or people that they have seen on the internet are saying.
Yeah. So in communication, we call it testimonials. All right. So just like we do in church, right? People give testimonies. They go and say, So those testimonies that people give, success stories that people give, it makes people to be called into that act. Good point. Yeah. Who else? How can we explain these things? Yeah.
Gilbert.
Yeah, Gilbert.
So the initial thing was for all of us to think along the lines of greed because of the unrealistic rates that were being offered. But further to what Michael said, people also find themselves on the lower end of investment knowledge, investment information.
Yeah.
So I think just along the line of the rational process we were talking about, if he needs to invest something and he goes out externally to look for information, and all he gets is people giving him testimonials, people telling him that this really works because the person deals in gold, and gold is an expensive venture. You can make a lot of returns on it within a short period of time. Maybe innocently, majority of them also went in, not as a result of greed, but lack of choice, lack of knowledge. That could also push a lot of people into the
You're right.
The whole process.
And then of course endorsement, isn't it? Because here's the case: you saw him work with big people in society, saw him, do big things with big people in society, meeting chiefs, meeting presidential or government officials, talking about, doing a lot of big things for the country, right? So that actually, draws endorsement, all right? Believability for people to believe that indeed this is genuine, isn't it? Yeah. So good point about the knowledge that they get from, all these, sources. What else? What else can we think about? What else can we think about? I think that also the uncompetitiveness of the investment market, isn't it? Because people look around and there is very little investment, markets or investment sources that they can put their money. And most of these investment areas are so uncompetitive that almost everybody is offering the same thing, all right? And people are not actually getting what they think would be, commensurate to what they invest in. So when someone is actually completely giving out something that is out of the ordinary, something that is far more competitive than the traditional, market, they feel tempted by it, isn't it? So we could ascribe so many reasons why, people will be tempted in having men's gold, having DKM, etc. I mean, the greediness is the fundamental debate that we've had in this country since those issues happened. And there were, suggestions that people would say, why didn't they look at, the interest rate? Even the central bank's rate, so and so is this, in the market across the banks, their rates are this. Why do you think that these people can actually give you this amount of money? And we made all these rational decisions thinking that the people, or all the people who were making these decisions to invest in men's gold DKM, were at par with us in terms of reasoning, all right? We forgot that not everybody had that insight, or even those who were academics and were part of the victims. If you're an academic, doesn't mean that you know or you have financial literacy. So just like, Gilbert was explaining, when you go out there to look for information and all that you're getting is a confirmation that this works, all that you're getting is testimonials, because as, Michael was saying, success people who actually invested earlier, there's evidence that they succeeded. There's evidence that they have made money. And as Bridget said, somebody came to her office and confirmed that he invested 100,000 and he got worth his investment. Why wouldn't you put your money? Do you get it? Of course, it makes sense to actually think, oh, really? And what makes it so potent is that if this person is very close to you, for example, if this individual who was telling Bridget that he invested 100,000, he got his investment and he got satisfaction from it. Let's say that this individual is very close to Bridget, either she's a friend or is a family member, and you have physically seen that this guy actually got his money and he's even bought a car like this. Certainly, your trust in the scheme will be high, isn't it? And so you would actually make the attempt to put in the money. So you realize that there are a lot of things, behavioral, issues that would actually prompt us to take some of these decisions that otherwise look irrational. I don't know whether you're following the conversation. Hello? Have I lost you guys?
Yes, we follow. We are here. We are following.
Okay. Right. Yeah, I'm hoping that I don't lose you in terms of the technology. Sometimes the line cuts off. All right, good. So you realize that there are certain behavioral factors that actually contribute to people making, so to speak, irrational decisions. We may call it irrational because you would think that, but what's the going rate that somebody will promise you 30%, 40%, and you go in for it. Now, we are arguing based on what we think people know. And not everybody has that information, all right? Not everybody has that insight to actually think that this could be a scam. Plus, the idea that people has physically seen, people gaining, why can't they also gain? And then, of course, the uncompetitiveness of the. So all these factors actually come together to, to actually form people's decisions, which we may call it as irrational. Now, if we look at
Kobe, I want to ask your opinion on something.
Yeah.
So concerning this men's gold issue, there's another submission that I want to make. I just don't know if it's rational or irrational, and I want to know what you think about it.
Yeah.
So I also know certain people who were very aware that it was a scam. These people are very intelligent people who know what kind of scam it was, and were very aware that at any point in time it could backfire. However, they intentionally took the risk of investing controlled amounts and withdrawing at controlled times till there was a sort of rumor or some sort of indicator that the scam was about to reach the point where people would lose money, and then strategically stopped. Of course, some of them lost the last amount that was supposed to come, as in it is still locked up, but they had benefited more than they had put in over the last few months or years. Exactly. So with a situation like that, when it is carefully thought out, does it fall under rational or irrational factor?
Yeah, it is rational, because at each point in time, there's a deliberation, all right? So there's a deliberate seeking of it. Now, it becomes irrational. Decisions become irrational when the person taking the decision does not actually have a deliberate movement of it, but they do it because of certain factors, that actually govern their behavior, all right? But these guys who knew the scheme and who know at each point in time how to control the system and get the results out of it, it's a very rational decision making, right? So when you look at it, usually Ponzi schemes or the schemes that are pyramid schemes, the early gainers or the early adopters are mostly the ones who gain out of it. The rest down the chain, they're always or mostly the ones who would end up losing. Are you with me? So,
yeah, understood.
Yeah, because those ones at the head of the pyramid, they actually know how the pyramid, the scheme will be, and therefore they have all the information at hand to execute the plan and to be profitable at the end of it. So for those who did that, it's a very rational decision, making they were making. The subsequent ones, were irrational because they were actually falling on the success stories. They were falling on the endorsements. They were falling on the other, things that they could see to actually, make them take those decisions. So they were irrational, but the previous ones were definitely rational decision makers. Right. Okay. So let's go on. Go on, Bridget.
Please, your third point on the irrational consumer decision, the use of overdraft.
Yeah.
You see, actually, we have a package in our Prestige, okay?
Yeah.
Our Prestige Ultimate, there's one free salary advancement through overdraft. Like you are entitled to one free interest-free overdraft. So people will really patronize that. It's one of the advantage they have of having a Prestige Ultimate account, and they are enjoying that service.
Meanwhile, they have money, right?
Yeah, they have money. Some have huge sums of money.
Exactly.
In their savings account, but they utilize that one.
Yeah, and there's this saying that goes that people who have money in society are the ones who don't pay. So you see that the people who have money in society, they pick their phones and call people for things to happen. Yeah.
And do you know that we also have 1,000 credit card for them? It's just that at the end of the day, the annual fee will charge them. It's also an added service. We don't look at your company whether it's on our EML or not. Yeah. So long as you have a Prestige Ultimate account, we give you 1,000 credit card, and who are taking advantage of that?
Yeah. Because they want to reserve their monies for dry weather days, right?
Yeah.
All right, good point. Thank you for that. All right, so let's look at go on.
Yeah, Corey. Sorry, this is Jude.
Yeah, Joseph, yeah.
Yeah. I want you to help me. For instance, the men's gold issue, the regulator sat down, well, to me, unconcerned, but they claim they sent some circulars out warning people and all that. But I want to find out, whatever that they did, whether they were slow in acting or they didn't whip the guys in line quickly or whatever. I'm sure it also contributed to people thinking that after the regulator, it's not too hard on these guys, so you can still go ahead and do an investment.
Yeah,
and
right.
In the course of that, they're taking irrational,
Yeah.
So it's an external, factor influencing them, but not really their own self-made decisions.
Yeah, you're right, because you see, I argued. I think one of the times I granted an interview to one of the media houses, and I argued in my submission that if you look at it carefully, there were state actors as well as individuals of higher standing that actually contributed immensely to people's decision making. All right. Now, if I see the Minister of Tourism, all right, working with Men's Gold owner, Nam1, going to places and say Men's Gold is going to help build, or his foundation is going to help build this area for people, going to Musica, all right, and then saying that he wants to set up a scheme to help musicians who are now old in their lives, that they are actually struggling. You see a picture of him going to Kumasi and being received or welcomed at the arrival by a chief in Ashanti. All right. As a marketer, my conclusion is that all these people have endorsed the legitimacy of his product. And whenever he does that, he links it to Men's Gold. And let me tell you one thing that people didn't even realize. The name is called Men's Gold, So the men's and the gold itself suggests something, the brand name, right? And then if you look at the billboards, he uses only high-end celebrities, top celebrities, all right? And the suggestion is that all these celebrities, he's paying them, all right? So, and I remember I had a conversation with Ochami Kwame, and he was asking me, how does he actually, respond if he's queried by people that he's contributed to that? So I was advising him on that. Now, with all these celebrities lined up, with all his billboards looking gold, i.e., the color of gold, and what we associate color gold with, all right, wealth. And if you go to the headquarters, is actually glazed with gold, all right? Immediately what comes to your mind is that this is genuine, because there's a continuous endorsement of state actors and high-powered individuals in society who are actually working with this guy. He's taking photo opportunities with them, and he's actually splashing them, linking them to his company's image. So, and then of course you have a regulator who's barely almost sitting unconcerned. And I blame the regulator, because if you're a regulator and you think that this is illegal, you come out forcefully. You just don't put releases in the press thinking that everybody reads newspaper. Really? It cannot be possible. So in countries where they are serious, the regulator comes out forcefully and they shut the place down, because it has social good implications. It has social policy implications. In fact, elsewhere, it would have been the state responsible to pay off all these people or to put them back to where they are. But of course, this country, we don't test the law. And where we test the law, people are unconcerned to help. It's you're on your own kind of character, all right? But to be very, precise in my thinking, I think that the state has a lot to answer. The state has a lot to answer, because we sat down, saw this guy, met big people in society, greeted big people, and the media, razzmatazz that actually followed it. They made sure that every Men's Gold customer would see it, so that their level of trust could be high. I mean, if you see this guy working with the president, what would tell you that he's a fake? Are you with me? So there were so many signs that actually pushed people's faith in the trust so high because of the character that we saw him be with, because of the regulator's attitude. And so when people put the blame on the customers, I actually differ. Of course, people should have actually exercised restraint, but remember that not everybody is very, deep in their thinking of finance and finance-related product. Even not professors. Some professors can't even read their bank statement. All right, they have no clue how the bank statement, is read. So if you think that somebody's education would make them financially literate, you're wrong. And so if you think that customers should have seen that the interest rate and those analysis when they do on TV, I just sit there and I said, I mean, he's a customer. He's looking for, profitability, and everybody is. We are economic, animals. Why would you sit and make these analysis without necessarily having a forceful, stance when the guy was doing that? So the regulator was completely at fault. All right. I don't know whether it answers your question, Jesse.
I said, so can you say it was political?
No, I can't say it was political, and you can't lay the blame on the politicians. What I'm only saying is that perhaps we allowed him to manipulate the system, all right? We allowed him to use our leaders by taking photos with them, photo opportunities with them, the chiefs and things, and he blew that up in the media so that everybody can actually see that, in fact, he's a genuine guy when he was fake, all right? So you can't say it's political, but you can say that he made use of the system. System was lax. I mean, the system was so lethargic that he could actually make use of that and push his agenda. Joseph, I don't know whether I'm clear with you.
Very clear, sir. Mm-hmm. Thank you.
Right. Okay, good. So yeah, let's go ahead. So some of the rational consumer decisions that we talked about, the critique of it, is that all steps in the decision process need recognition, post-purchase evaluation, do take place at the same time, rational, all right? And consumers are well informed about product attributes and competitive offers. Consumers undertake sufficient information search to learn about their options. So the rational decision assumes, the rational decision-making process, there's an assumption that consumers do these, efficiently, but certainly we don't take efficient decisions, all right? And as I'm saying, nobody goes out there to buy a car and test drive it for a week. Who has done that before? Yeah? Bridget, your car that you drove or you drive, and when you bought it, did you test?
I don't have a car.
You don't have a car?
Yes.
Okay.
Not yet.
Dolores.
I learned how to drive.
Yeah, okay. Dolores.
Yes, sir.
Can you tell us a decision that you made that you were so conk about it?
And conk meaning I know that I won't regret the decision I've made.
That's right, that you were very emphatic in every stage.
You just mentioned buying a car, yes. And then, and trying to also get a mortgage and get a house, okay. Those kind of things, so yes.
When you bought your car, tell us the decision process. Did you actually test drive it?
Not me. I made someone do that for me because I felt that I didn't know too much about cars. So yes, I made one or two people.
Yeah.
I felt would give me honest answers to do that for me.
Excellent. So
yes.
Certainly is on the rational decision-making path. Now, those who did that for you, how did you monitor, or how did you come to invest? I mean, how did you come to trust their feedback?
Okay, so it's just from, interactions with them and you feeling that they know more than you in that area. So it's just what you know. Relatives, both were relatives, yes, both were relatives.
So typically, typically you see that that's the rational decision maker, falling on very close. And that's what we say, that for somebody to actually have a trust, you realize that the trust actually of a product, or the trust for product, is actually channeled through somebody, all right?
Yeah.
Or through a source trust. So the relative who actually did the checks for you, some way, somehow, is actually transferring their goodwill that you have for them onto the product.
Yes, yes.
You get it?
Yes.
So, and that's how we behave. Because
that's true though.
Because Sumesi has said that the product is good, the product is good.
Yeah. You know, and I think women even do that.
Yeah, go on.
I'm saying, yes, that's true.
Yeah.
Because, you know, it's like, let's say I see a car and I think, oh, wow, I love this car. And then somebody who I feel, you know, there's some people you take their words as truth. Yeah. And then the person says, this car won't serve you well in about a year or two. Suddenly, all the love, all the everything you were feeling towards the car or whatever product just begins.
Hello? Yeah. Hello? Have we lost you? Hello?
I think we lost her.
Yeah, okay. So yeah.
Hello.
So, yeah.
Sorry.
Now. Yeah.
My kids were barging in. I just had to go and lock them out. So yes, it's true. And you know, even with simple things like relationships, as girls in school, let's say someone comes to say, "Oh, I like you," and then friends who, you know, the friends you move with, friends you do everything, say, "This boy," then all of a sudden, the boy doesn't look attractive or like.
Exactly.
And it's true. You can ask the girls.
Yeah.
If the people who you hold in high esteem, so to speak, say, guy we cry, then all of a sudden you just keep quiet about the way you feel about them. It's true.
Yeah. So there's always a transference of, you know, what do you call transference of goodwill, and that's what explains the use of celebrities in advertisement. All right. So you realize that companies will use certain characters in their communication. Why? Because they are seeking to transfer the goodwill that people have in that character onto their product. And this is exactly what we are learning. All right. That so you see, you know, let's say Nike or Adidas use, let's say, what do you call Rafael Nadal, or, you know, let's say Usain Bolt, and then they use that person to advertise for them because the qualities or the characteristics of the product aligns with that of Usain Bolt, knowing that by using Usain Bolt, those characteristics will be transferred, all right, or the consumer would actually see exactly what the characteristics they are talking about in the product. So it is always about transference of, you know, what do you call goodwill. And in this case, as we're discussing, you know, with men's gold issue, that's exactly what happens. All right. They transfer the characteristics of the goodwill onto the product. All right. So we're saying that the rational theory says people would actually take conscious decisions to seek out information efficiently. All right. And they would do so that they will become well informed about the product and its attributes. But in some cases, that is not true, because we may not be very, you know, competent in judging product qualities just by the idea that somebody actually told you. Maybe the person themselves had gaps in their appreciation of that product type, but they may not actually tell you. You know, Kukwa says, they say when you pray for a husband, pray for his friends because they are the board directors of your marriage. You know, have you read it? What Kukwa is saying?
Yes, we have.
Your husband's friends are the board of directors of the marriage. So it means that every Sunday, make sure you do fufu and abekapa for them.
For them to come.
I'm telling you. That's a nice one. Great. Okay. So and these are some of the realities of life, isn't it? How some people or people actually, you know, adapt to the sustenance of the particular thing that you're looking at. So consumers' assessment of risk reflects through capabilities of event occurrence and corresponding outcome benefits. This is what the rational theory is actually saying. But of course, we say that there's dispute because not all the time that people will be competent in making sure that they can actually judge product qualities. Okay. Now, I think, Michael, the issue that you were talking about, the headings, it looks like some of the headings are not reflected. And so I think it may not necessarily be the file type, but maybe from my end. All right.
Okay, but then for this one, it's the heading that is not showing, but for a majority of the others, there's a white banner of sorts covering the heading.
Okay, okay. I'll do the PDF. Okay, great.
Okay.
Now, so on this slide, we're going to discuss what we call heuristics, all right? Now, in the consumer decision-making or consumer behavior, we say that consumers actually use certain shortcuts, and that's part of the irrational behavior, theory. We end up using certain shortcuts in arriving at decisions. I don't know whether you guys are aware or you have actually experienced that in your life. Who can actually give us an example of recent decision that you probably use a shortcut to take the decision? Who can give us an example? Dora, we haven't heard you speak. And let me see who haven't spoken today. Loretta, you haven't spoken. And Dora.
Sorry, I'm thinking about it.
You're thinking about it? Okay.
Yes, please.
Okay, we'll come back to you. Yeah. Who can tell us an example of decisions that they made that, they use a shortcut? Yeah?
Can it be any decision at all?
Any decision at all, yeah.
Okay, so I can give a scenario. So I work for a digital marketing agency, and I'm in charge of a number of client accounts and I am required to be at their premises at least once every 2 weeks to take a new batch of staff photos so that on their social media they can do some sort of staff highlights every 2 weeks or so. But because of the COVID period and everybody trying to stay home some more, what I did was that I made friends with somebody at the company who has, a fair amount of tech savvy skills and has a fair understanding of how camera phones work, and liaise with him to be doing the job of sending me the photographs, and then I will just use and then I can use those to do the work I'm supposed to. So getting him to send me the photos instead of me having to use time and resources to go there, I think is a shortcut to me getting the work.
How did you come by the decision that they had a fair knowledge of tech?
So in previous visits, because of the fact that I have to speak to different staff to gather their information to use for these staff highlights, I've had conversations with most of them, asking, for the staff highlight, I will require information like who you are, what you do, and what your interests are. So for some of them, you can tell from the answers that they gave that they have a fair grasp of modern day technology.
Exactly. So you see, Michael is coming to the understanding that this guy is tech savvy based on interaction that they've had. For all you know, they probably had read and know some terminologies, some 1 or 2 terminologies. So they apply that in the conversation. But immediately you assume that practically, perhaps, they are tech savvy. Are you with me? So certainly that's a shortcut, decision making based on, their articulation of certain technical or certain jargons within the tech space, conversation that he had with this person. Great. Who else had made a decision using a shortcut, what we call heuristics? Who else? Yeah? And you know the usual conversation that they say men are attracted by what they see. All right, I hope all of us know that. Are you guys there?
Yes, I'm familiar.
Yeah.
Familiar with that concept.
Exactly. So Dolores, to fall on your example of the guy coming to say that they like you. All right. Are you there?
Dolores.
Dolores, are you there?
Experience. So
I'm here. I'm sorry.
That's
here.
all right. That's all right. Let's fall on your example that a guy will come.
Okay.
They like you, and then your friends will say, "Ask for this guy." Now, what do you think are the reasons why they say they like you?
Because I guess maybe they like what they see. They like
exactly.
Talk. Yes, how I carry myself or something. Yeah.
So that's the shortcut. All right. That's
okay.
Men, we call it heuristics, as in shortcuts in making decisions. So men are attracted by what they see. So immediately they size you up and then they say, oh, I like you. Yeah. Now, then before they go into the detail, you know.
Yeah.
But by the time they get to know the detail, they had already pronounced I like you already. They have already taken the decision. All right. And bingo, they go. So we always say that men, make decisions based on what they see, especially when it comes to relationship. All right. Yeah. What other decisions do we take using shortcuts? Yeah.
I think.
Yeah, Michael.
I don't know if this qualifies.
Yeah.
I don't know if this qualifies, but I think that reading reviews that other people have of a product.
That's correct.
Could potentially be a shortcut because.
That's right.
Yes, you are not. Yeah, it's.
Yeah, and that's why companies actually buy reviews, isn't it? Companies sponsor people to write reviews for them because people may not have used the product or do not even know who had used it. But immediately they see reviews and they go, oh, this product is good. Why? Because somebody has written about it. And that's where you see a lot of our churches, on TV trying to demonstrate their power through people. So somebody says, oh, I was this, I was that, and this and that. And then immediately people actually believe in that person. Yeah. So these are some of the shortcuts that we use to arrive at decisions. Somebody gives you an envelope, brown envelope, very packed with cash, all right? They hand it over to you, say, hey, Charlie, my ye. Because you see that the envelope is so big, before you realize it's only one city. You go and count it, and it's not even up to 500 Ghana cedis, right? But immediately you see that it's a very big envelope. You just do your sign of cross and you say, I'm rich now. All right. So the same way, we say that there is a limitation in our cognitive circuitry. All right. Human beings have a very limited, cognition ability. Because of that, we tend to use shortcuts in, making decisions. And so the sources of our heuristics is limitation in human cognitive circuitry. We have emotional limitations, and we have insufficient knowledge, So one of the limitations in cognitive circuitry says that we probably cannot actually count beyond 7 when we are doing certain things. Like when you're actually swimming and then you are going on lapses, all right? By the time you get to the 7th lap, you have miscounted, and it happens even when we actually, doing certain activities. You go, oh, how many times have I done this? Then somebody say, oh, you've done 5 times or you've done, 3 times. We tend to actually, lose concentration on what do you call activities that we do. So the theory says that we always have limitation in our human cognitive circuitry. Joseph, yeah, you want to say something?
Yeah, Doc, I just remembered one example that I have.
Yeah.
I think about 2 weeks ago, I was not feeling well. And instead of going to the clinic, I called my personal doctor.
Yeah.
And he took me through, I mean, what was wrong with me and all that, the symptoms. And he prescribed some drugs for me. I went to the pharmacy, got them, and I think I was okay. So I didn't go through any lab test, any whatever queue in the hospital and all that.
Excellent. Yeah. Now, what advised you that you have made a competent decision?
Because for me, I trust him. He's been doing this for some time now.
Yeah.
So it's always more likely that I'll follow whatever that he tells me. Or follow his suggestions. Yeah.
That's right. So because previously he had actually fulfilled that, you've dealt with him over time, and you had followed his instructions previously, and you've gotten better. All right.
Very, very, in fact, best.
Exactly. So that becomes what we call the anchor. We'll come to know what we call anchor and adjustment. All right. So you are anchoring your decision on the previous experiences that you've had with him. And then you think you have taken a competent decision in that sense. All right. So that's what, the heuristics actually talk about, that, one, we have limitations in the number of times we engage in something. We also have what we call the asymmetric discounting. That is, we use certain uneven measurement to actually come to a conclusion in terms of, looking at the output of, certain things. There's also what we call the attraction effect. The attraction effect is what I told you about men, all right? Men size women up, and immediately they get attracted to the woman and they say, I like you, without even knowing the detail,
Kobe, may I say something about the heuristics and bringing it to banking or the financial sector? You could have, say, an account manager, your relationship manager, and then they move from one bank to the other.
Yeah.
Just by virtue of the fact that they've moved and they come to you to sell to you their new bank, you just move, not really knowing what the bank's mission vision is, what the bank, just because of that relationship manager of yours who has, taken care of you in times past at your previous place, you move just based on that.
Fantastic.
Is that also considered?
Yeah, fantastic. Because now this is what we call the transference. So this advisor is actually transferring their goodwill onto the bank. Yeah.
Okay.
Because you can trust this person. She's a good, relationship manager. She's always there for you. So. And so once she goes into a new bank, you know that similar things will happen.
Yeah.
So this advisor had technically transferred their characteristics, their goodwill onto the bank in the eyes of you, all right? In your eyes, because they are there, you would get good service.
Okay.
But the point that you have missed out is that perhaps that new bank does not have the systems that the old bank has.
Yeah.
That new bank does not have the procedures that the old bank has. Perhaps they don't have the same policy that would allow this relationship person to function as they did.
The way they used to, yeah.
But they have managed to transfer their goodwill onto the bank. And so you're actually following suit. That is the reasons why sometimes when banks or when institutions poach some key, employees, the employees demand more.
Yeah.
They demand more in salary. Or those who don't demand more do not actually understand their value. So technically speaking, if a company actually poaches you, you're supposed to bargain for a higher salary or higher, benefit. Why? Because you are transferring your goodwill onto them. You see? So you are very right on that. All right. So this is the kind of heuristics we're talking about. So that should inform us that even in our line of business, whether it's financial services or what, any business that we're in, we actually can rely on some people's goodwill to attract customers. And these are some of the things that you must know and appreciate so that you'll be, very effective in doing it. Now, under the emotional, side, the source of heuristics, we say mental budgeting of funds, believe in eventual turnarounds, reversing risk preferences, etc. So we'll go into detail and we'll see what we mean by this. So the effect of the limitation in human cognitive circuitry says that magical number 7, which says that we cannot actually count beyond 7 lapses when we are swimming or when we are doing certain things. Hyperbolic discounting, that is deliberate exaggeration, etc. We'll go into detail. So the magical number 7 says that consumers cannot store more than 7 items in short memory because they have difficulty in conducting mental arithmetic, difficulty in remembering numbers, and difficulty in appreciating interactions among product attributes. When you are engaged in some financial discussion with somebody and say, oh, okay, so I had 100,000 from this guy, and especially when it involves odd numbers, all right? And then so somebody actually gave you 2,500 and somebody actually gave you 800 Ghana cedis. Then you are trying to put them together. Then you say, okay, how much is it? You see people doing this, yeah? And you're most likely to actually get the wrong, total, especially if they involve, what you call odd numbers. So most cases, if it's even numbers, we are most likely to get it right. But when the numbers are very odd, we tend to get them wrong, right? So the difficulty in we conducting, a mental arithmetic actually influences our consumption, all right? And so you realize that whenever, people are actually bargaining, for some product, or we see pricing, all right? And the pricing is maybe 9.9999, all right? People get confused and they're asking, okay, so why don't you round it up? Or why don't you do this? Why don't you do that? All right. And all these things are part of, decision making. Or sometimes because it's not up to 1,000, all right, it's 9.999 or 99.9. People think it's cheaper than the one that says 1,000 because their one is what 999, 0.9. Yours is 1,000, and so people could actually think that theirs is cheaper than that. So you look at some pricing strategies, and they do all those things in order that they could actually confuse customers, or they could actually get customers onto their side. Now okay, let's see. Sorry. So some of the factors in consumer credit, product, home mortgage, and we're talking about the difficulty in customers actually putting together some of these numbers up to 7 is about this. So let's take a home mortgage, and the home mortgage has interest rate, variable versus fixed rate, lock-in period, origination fee, processing fees, service arrangement, escrow accounting, penalties, brand name, etc. Now, take, for example, these are the benefits that the consumer gets, all right? Or these are some of the, the attributes of that particular mortgage. Do you think that consumer would actually remember all these attributes? Yeah.
Oh.
They will not remember.
No.
Right.
Too much.
Yeah. So there are too many. And in fact, some people haven't even heard escrow accounts before. All right. Now, for these lists, most likely to be remembered are which ones?
Interest rates.
Interest rates.
The penalties.
The penalties.
The fees.
The processing fees.
Yeah.
Brand name.
Brand name, yes. Right. And perhaps these are the only ones they can remember. All right, these are the only ones they can remember. So processing fees, they can, yeah. So the point is that why do you see banks putting so many attributes of one product on their brochures? Or even insurance firms. Why do you see, and even other companies, all right? So that when you watch somebody's billboard, they have so many things inscribed on that. And we know that people cannot retain more than 7 items in their head, all right? So why would you want to put all these things as the benefit?
I can think of 2 reasons.
Yeah.
Okay, so the first reason is I think even though they know that people can't retain all of them, they also know that if you put more benefits on a list as opposed to less, people will perceive what you are offering as being more valuable. Because instead of telling them 3 ways in which they can gain, you are telling them about 12 ways in which they can gain. So if they are going to compete, if they are going to compare your offering to what a competitor is, if a competitor lists only 6 and you list 12, you stand at an advantage because obviously you are giving somebody more perceived value.
Okay.
The second reason I can think of is because different customers have different needs. Whereas somebody may value brand name more, somebody else may value interest rates more. So since you don't know which customer would react to which offering that you have, it may be better to list all of them so that everybody who looks will find within that list what they.
Yeah, we've lost Michael.
No, that was the end though. Okay. That was the second reason. Yeah, so
okay. Yeah, so I get the point that you made. So obviously, if you know, the first point that Michael made, fantastic submission as obviously coming from an agency perspective. And the first point that he made, it itself is a heuristic, isn't it? Because he says that people actually substitute the idea that you have more than the other ones to be that you are the one who is in the good, isn't it? So one company is actually offering 6 benefits, you are offering 12, and they think that you are more, you know, you're offering more quality than the other, you know, company. But obviously that's from that perspective. But the issue is that, are they able to retain all these 12 in order that they can remember which one of them? Or would you have been efficient or effective in actually carrying out a kind of research to understand amongst the spectrum of your customers, which of these benefits actually appeals to them most, and make sure that you could actually put these ones there as opposed to putting all the 12. So that's another decision point that you want to make. So I get the point that customers may substitute the number of factors or the number of attributes that you have to mean that you give them a lot more choices than the one who is giving very few. But the other question is that, are they able to retain that, you know, in order that it would serve that purpose that you actually, you know, put all those one there. So it has to be a trade-off between, you know, that and how the processing abilities of the customers are, in order to be able to come to a determination that you put a very few or you put the more there. And then of course the other point is about, you know, making sure that each customer actually finds something in it that actually concerns them. That is also true. But when you do what we call segmentation, you probably will be effective to identify that in all the customers that you have, you can actually group them into, let's say, 4 key categories. And among these 4 key categories of customers, perhaps some few benefits would appeal to them. I don't know whether, Michael, you get me right.
Yes, I do.
Mm-hmm. So we want to balance it. Yeah, go on.
I was going to say, so on that point, for instance, you also find out that when the agency is, so there are two ways in which we have, in which we do work with a client. The first way is a client approaching us or putting out information that we need these services, so come and pitch to us to give you this job. The second way is related to the point that you just made, in that sometimes we would identify a certain client which may need some sort of digital service. Then we approach them and say, we have done an audit of what you are doing at the moment. Now, these are 15 recommended things that we can do. This is the list. We can do social media marketing, you can do photography, we can do videography, we can organize an influencer campaign, etc, etc. And then from this list, we are not saying that do all of the 15. We are saying that we are recommending maybe these 4 or 5. Feel free to tell us that you want these other 2 or 3. And then let's put a package together.
Excellent.
So there's that option too.
Excellent. Excellent. Good point. All right. Thank you. Yeah. Any other questions or contribution? And the same runs through it. So you see auto loan, line of credit, credit card, all of them have attributes, benefits that perhaps could actually suit a customer. But on the count of the magical number 7, on the count of that heuristics, our inability to retain a lot, the issue is that we probably look at which ones would really ring a bell or would connect to the needs of the customers the most, and make sure that we can at least bring them up the ladder, so that customers immediately they see that they could go for it. But if we actually mix them up and then we present all of them there, the customer may not be able to retain all of them, and as a result, we may lose out. So that's a very good practical point that Michael gave us. Now Joseph,
Yeah, Kobe.
Yes.
Please, can we talk about historical? In the past, we've had this notion that if you have a very big table, a very big desk with so many files, it means that you're doing a lot of work.
A lot of work, yeah. You're a big man.
Yes. So when you have flyers, you have all that with a lot of information. In fact, if your information is scanty, somebody will just pass by and think that you are not serious. You want to flip in and see more.
Yeah.
And we've still not moved away from totally from traditional marketing to the electronics. So we still have, those traces there.
Yeah.
So we'll get there, but I think for now, people still want to see a lot of information.
Exactly. You remind me of a current job that I'm doing. I consult for companies. So currently I'm doing an IMC, integrated marketing communication for a firm. And I remember we were supposed to have a release, a press release. And then we scripted the first one, took it to the bosses, the authorities to have a look. And then they came back with a very long one, just as you're saying. Then I said, well, because it's long, it may even put off the target that we're looking at. And that's exactly what the man was saying. He says that they have to put every bit of information there, because if they don't do that, the people may think that, they have nothing to say, or they have very scanty thing to say. I said, well, it would also put people off. He said, no, but they want it this way, So the idea that people see a lot on your table, and that, like you said, Joseph, that's been with us for a very long time, So people will want to see that you are seriously working because, you have a lot. And that reminds me when we're in high school, when we are going to do, TDB, or we are going to study, you see some people, they will pack their Abbots, they will add this, they will add that, and you see in their hands, plenty books, all right? But when we see somebody only, folding his exercise book and put it in his back pocket and he's going, we think that person is not serious. You know that? You remember?
Yeah, I do.
I go with a serious crowd. And such people will go for exam and they will blow it.
Yes.
And then those who are holding the Abbott and
Macmillan.
you know, the people who go, fat books, so, but they will come to the exam, so, you know, Fala, they don't do nothing, you know. So that's exactly, you know, the notion we used to have. Great point. All right. Now, the other, you know, point that we're talking about is what we call asymmetric discounting. All right, asymmetry is lack of information, and you realize that people actually make decisions, you know, even when there is not enough information at hand. All right, and they discount, you know, based on the information available, i.e., they exaggerate the results or they underestimate the results, all right, because of, you know, lack of information or uneven information that they have. And we are learning this because it is also crucial for our decision making, especially when we are managers, all right? Now, to what extent can we actually influence consumers to make the choice and be sure that they have made the right choice so that they don't take the product and come back for a replacement or a comeback to say that they are returning it? To what extent are we giving out the required information? And how much information is required is also the question, or has to be, you know, determined, so that we're not giving the customer too much information, neither are we giving the customer too little information to make a judgment. All right. So let's take, for example, scenario one. You are telling the customer that an apple in a year or 2 apples in a year and a week, they should choose one. Let's say this is a promotion that you actually, you know, conducting. You put up a promotion and say, if you buy this product, I'll give you an apple in a year, or I'll give you 2 apples in a year and a week. Which one are you going to select? Or which one do you think the customer will select?
The second one, B.
The second one, B. 2 apples in a year and a week instead of an apple in a year. Why?
For me, both are essentially the same, but the way that it has been worded, it appears as if you would just for the patience of an extra week, you are gaining more.
That's right. So you
are. But then, however, both are essentially the same thing.
Yeah. So suddenly they're going to take the 2 because they think that having waited for a whole year, I mean, you should be able to wait for extra week to get an extra 1 week to get an extra apple, isn't it? So just as Michael said, you know, it's worth, you know, waiting for that extra week to get 2, because after all, you've waited for 1 good year. All right. So they will make that decision. But of course, what are some of the intervening circumstances, you know, or context in this particular scenario? We don't know. All right. The information is not available. Now, scenario 2, an apple today or 2 apples a week from now. Which one will you choose?
As for that one, I think it's more difficult to choose. I think that one is more difficult to choose.
Yeah.
Because with A, there's the instant gratification of getting it today, right now.
That's right.
And then with the B, there's the promise of, oh, if I wait more, I'll get 2. So this one is more difficult.
Yeah. You see? So there is a bird in hand theory here, isn't it? So they say that a bird in hand is worth than a million in the bush, isn't it? So the person is thinking, today I'll get the apple satisfied, and then you go away. Now you're going to wait for a week, you know. But somebody is also going to say that, but waiting for a week and having 2 apples is better, isn't it? So you realize that in here, we're looking at consumer behavior, isn't it? 2 consumers are likely to have 2 different instances. Assuming that the one who is choosing the apple today is angry, all right? Master, a hungry man is an angry man. He's certainly going to choose the today one, isn't it? But if you are full, there's no need to actually ask for the apple today because you're already full. So you may think that, I can wait for a week, all right, to get 2. So you see the asymmetric discounting here, depending on the consumer's context, all right, they will make the choice based on the context. And based on
Bobby, sorry, just a quick question.
Yeah.
Is this a separate subtopic on its own, or is it related to the heuristics that we just spoke about?
Yeah, it's all part of the heuristics. So you see the heuristics, let me see, the heuristics are here, all right? Part of the limitation in human cognitive.
Okay, understood.
So we looked at the magical numbers, so we are now looking at asymmetric, uneven discounting. Then we'll come to attraction effect. So all these are, the heuristics that we're looking at.
And heuristics are they, how do I ask this question? Is it analyzed from the consumer point of view or from the marketing point of view?
Yeah, so you, the marketing manager, we're looking at what are the shortcuts that consumers use to arrive at a decision. All right.
Meaning that you're looking at ways to capitalize on this to
exactly. Yeah, and then we are embedding those into our decision making for embarking on marketing activities in terms of our brand, product decisions, communication decisions, distribution decisions. Are you with me? So
makes sense.
We are looking at these to apply them in our marketing activities. You get it?
Yeah, makes sense. Thank you.
Yeah, Gilbert, your hand is up.
Yeah, Doc. This scenario we are describing, I think this week drew my attention to something. Maybe Dolores can relate to it more. I'm told it's coming from her end. You know, those who had their investments in banks that lost their licenses. So those who had amounts that were huge, being thrown into bonds, and then it will be paid over the course of 5 years.
Yeah.
And every year, I think you would have a percentage of the amount you can take. But a friend told me that he was informed you can come pick half of the amount owed. I mean, amount, which is going to be spread over 5 years. They're going to pay you half of that amount now. Then it's off. You are just done. Or you wait and take it in tranches over the next 5 years.
Excellent.
So he sat down and did some calculation, and he realized that if he factors in inflation and everything, also takes the 50% which he's being paid now and invest it in some products over the course of the 5 years, he would end up with virtually the same amount that he would have waited to gain in 5 years.
Yeah.
These investments are going to be on 0 coupon. So you are not going to get interest on it for the next 5 years or whichever period you are taking your money. So this brings in an apple today and then the 2 apples in a week.
That's
right.
That's the situation. That's right. Fantastic example. So if you look at it from the regulator side, they have also made the same calculation. You see, so it ties in with Michael, the question that you asked. From which perspective are we doing this analysis? The regulator has done that analysis and realized that he can tempt people, with that 50% today. All right. Or some people may decide to wait, and therefore he can also tempt those people for that 5-year, limitation. So they have done the calculation and realized that for some categories of the customers, we can actually tempt them in this manner. Either way, the regulator will gain. And if the consumer did the analysis, just as the one that Gilbert talked about, had done the analysis, they would also realize that they stand to gain for option 1. All right, if they actually plan well and take the right decision, than waiting for the option 2, which the investors and the regulator says you can come 5 years time, we can spread it over and over. But you see, this Gilbert's source, the one that was making these calculations, is actually coming from a rational decision-making perspective where they have factored in all conditions being equal. Are you with me? And thinking, if I get the money and plug in here and plug in here, plug in here, I would realize the same return as waiting for the regulators 5 years. Until you realize that there is an economic shocks, i.e. economic underperformance of the states, perhaps the mismanagement of where you are going to plug the money for the investment, many other factors can actually come in for you not to realize the return that you think you could realize, in the next 5 years time. I don't know whether, Gilbert, you understand the point I'm making.
Yeah.
You see, so, but then of course, having made those decisions, all things being equal, they could realize the 5-year term that the regulator is actually offering. So these are some of the analysis that you have to make. And that's why we're saying that when it comes to the asymmetric discounting, for example, consumers' decisions will be hinged on their practicality or their context. So you would find that whereas option 1 will be suitable to some consumers, option 2 would not be suitable to other consumers. And people would have the choices to make depending on their context or on their issues. Joseph, you want to ask a question?
No, please.
Okay, your hand is up. That's what I was asking. Okay, all right. So I hope you guys understand the point that we're making. And these asymmetric discounting strategy is used by firms in order to tempt some customers, all right? And very recently, I was in a committee and we were discussing some of the approaches the university should use in attracting students. And I was suggesting to them some of these methodologies. And then some of the professors who are in other faculty, they were like, hey, you these business people, you be bad, oh. Because they don't understand some of these concepts. And that's exactly what we apply in promotions, all right? You don't just do promotions just like that. Promotions must be targeted, and they must be targeted in such a way that the philosophy behind it would actually appeal to people's needs or will be tailored to people's needs in order that they can take action. So if you're doing a promotion and you don't factor in some of these things, it will not be effective because you realize that some people may come for it, but there will be very few. Why? Because you haven't actually thought about the psychology behind the promotion and how you want it to actually influence the consumer's decisions. Am I clear on this? Am I clear on that? Any questions or contribution? Okay. Is it time? Bridget, what time are we supposed to finish?
Oh, it's past time, 15 minutes.
Oh, it's 50 minutes past time, eh?
Yes.
Okay, I'm taking my time back. The time that we have to wait for. Okay, so we'll end here. So let's say asymmetric discounting. Most people choose option B in scenario 1, but chooses option A in scenario 2. What has changed? Just as we discussed. All right, and then it says that, for example, good news, you have a 2,500 tax refund this year. You should receive it in about 6 weeks, but we can pay you 2,400 cash if you now cash for it now if you want, just like Gilbert explained. All right, so they put in some of these targeted mechanisms to attract. Now when you go for the second option, the implied discount rate is 36%, but you may realize that even the discount rate or the prevailing discount rate is not up to 36%, but because of the company's readiness to pay you cash now, they have actually factored in and make sure that they don't lose. And then you also stand to gain, depending on your situation at the time. All right. Maybe we can end here and then we'll continue the heuristics, the next lecture. I hope you have understood it up to this point.
Yeah.
Right?
Yes, we have.
Okay. So any questions, or maybe you can pen down your questions on your contribution next time when we meet. All right. So,
yes, please.
Thank you. I've enjoyed the conversation, and I hope you have enjoyed it too.
Yes, we have. We have also. Thank you.
All right. So I wish you all the best for the rest of your Sunday.
You too.
You too.
All right. Thank you.
Thank you.
Bye. I'll send you the tape. Yeah, Bridget. All right. Bye.
And
Okay,
the
thank you.
slides,
Bye.
Oh yeah, and the slides. Yeah, I'll compile it and get it.
Okay. All right. Thank you.
All right. Bye.